Greetings from Three Edge Asset Management. My name is Fritz Folts, and I am the Chief Investment Strategist here at Three Edge. Pleased to be joined here today by Steve Cucchiaro, President and Chief Investment Officer at Three Edge. Today is Saturday, March 28th, and based upon the high degree of uncertainty that we've seen in the markets recently, Steve and I have decided that we are going to make a short video at the conclusion of each week in order to provide our clients with our perspective on what's transpired in the week just passed. So let's get started because it was an eventful week. Last week, we had the U.S. now leads the world in the number of COVID-19 infections, New York City being the epicenter in the U.S. Jobless claims in the U.S. last week, over 3 million, which is literally off the charts. The Federal Reserve has now provided unprecedented degree of monetary policy stimulus in order to make sure there's enough liquidity in the financial system. And yesterday, Congress passed a $2.2 trillion rescue package. So Steve, a lot has gone on over the past 5 weeks. Maybe you could look back and give us an idea on your perspective of where you think we are.
Well, it has been an extraordinary week, Fritz. And to gauge what has just happened, it's nice to look back in historical perspective and look at the two biggest crashes in history, the 1929 stock market crash and the stock market crash in 1987. Believe it or not, what we've seen in the last few weeks was a steeper decline and a sharper decline than both of those cases. So this is truly historic. Now, there are optimists who believe that we are looking at a V-shaped recovery in both the stock market and the economy. However, we believe that for that to happen, the coronavirus will have to peak very soon and go away soon. Consumers, after this is gone, will have to get back to their spending habits that they had before as if nothing happened and life will go on as normal. And you have to believe that the markets were fairly valued before this all started. And we take issue with all three. Coronavirus, the best medical research shows that we're still climbing. We're not at the peak yet. It could be a few more weeks before we peak, and then it'll be a slow recovery after that. There's evidence that once there's a recovery, that it won't be life back to normal. Consumers will be quite shaken by this. I know in China that's been happening. And rather than be a lot of pent-up demand and everything getting back to normal, it's been a slow, rocky recovery. And then finally, most importantly, we believed that the U.S. stock market was highly overvalued before this happened. So we don't think that we're going straight back to making new highs anytime very soon. However, we have had a stop in the sharp plunge, and it coincided with market intervention, government intervention, this massive stimulus program and the Fed policy. And typically, bear markets have three phases. The first initial sharp down, and then there's a relief rally when governments intervene. This happened in 1929, it happened in 1987. And off the bottom, you got a quick rally, and then you tested that bottom again. And then there was this bottoming process. And then you get a lot of choppy volatility, but with an upward bias. And that could last a few days. It could last, actually in one case, after the 1929 crash, it lasts 4 months before going back down. So that certainly could happen.
Okay, so we have witnessed both unprecedented intervention by the Fed and now this record $2.2 trillion government rescue plan. And I'm just curious how you think about the potential implications of these massive interventions, both in the short term and the long term. And also, there are obviously intended consequences behind these policies, but probably also unintended consequences that could come into play down the road as well. How do you think about that?
So in the short term, there's no question that this massive rescue package stopped the downward spiral that was happening in the stock market. Investors who had too much leverage, who borrowed too much money to buy their stocks, were forced to sell, and forced selling caused the market to continue to go down and caused more forced selling, and we were in a downward spiral. So this has stopped for a moment that downward spiral. So that's the good news in the short term. Longer term, I see more problems. What people aren't focused on is the fact that the government is spending massive money that they don't have. The government is having to borrow this money. Now, the government started this process already $21 trillion in debt. And in the last year, which has been a good economy, added another $1 trillion of debt just in 1 year. So that's before any troubles hit. And now it's expanding the debt in an accelerated fashion. And that would normally crash the bond market, except the Federal Reserve Board has come in and declared that they're going to print unlimited amounts of money, whatever it takes, to backstop the government and backstop this economic shock that we're feeling. So very good in the short term. long term, this could be trouble. One thing we know from the past is that when the government comes in, like they did in the financial crisis of 2008 with a big rescue package, they don't just come in, rescue, and get out. They stay in. And we saw how much difficulty the Fed had trying to normalize policy, and they never were able to do that without causing big problems in the market. So what this leads to is the specter of financial repression. We last saw that in the mid to late 1940s with the big debt we built up in World War II. Basically, what the government did was they forced interest rates to be artificially low so the government could begin to get loans from people buying government bonds to slowly pay down their debt with artificially low interest rates. Well, that's not good news for savers when the Fed and the government are forcing you to get artificially low rates for the savings that you then lend to the government, or for bond buyers. So what we see longer term is we see difficulty in the market after providing all the stimulus, being able to pull out gracefully. We see financial repression where the Fed is going to have to keep interest rates low. Otherwise, the government's going to have extraordinary interest expenses with all this massive debt. And that's going to cause negative real interest rates, or interest rates below the rate of inflation. That is bad for bonds. It's very good for gold. And it could be very good for undervalued equities, but you have to be careful and make sure that they're undervalued.
So I have a quick follow-up, if you don't mind. If we were to start to see inflation, where would you start to see that show up?
It's going to take a while. So initially, we're going to have a deflationary shock with the tremendous loss of demand, and that's what we're seeing. But that deflationary shock is met by unprecedented monetary stimulation, or another way to say it is the Fed is going to print lots and lots of money.
Right.
And that will initially slow the deflation. But then, like what happened in the late 40s, when everyone least expected, all of a sudden you'll start to see inflation pop up. And so the way that you might see that is not necessarily immediately consumer price inflation, but you might see the value of currencies be debased or be lowered. And then that in turn will start to cause inflation, because people will say, why should I hold on to my dollars, which are earning less interest than inflation and not very attractive, when I could hold something real, some real asset, something that generates a return above inflation. And that's when inflation starts. We had a period where no one expected inflation in the late 1940s, similar to now. And over a 9-month period, inflation rate went from less than 2% to over 8%. So it can happen again.
Right. Okay, great. Well, Steve, thank you for providing your insights. I think the takeaway is going to be that, well, we don't believe that the bear market and then last week's 3-day rally is the recovery and we're back on our way. It's going to take more than that to work through this thing. And so we feel pretty comfortable where we're positioned now, but with an eye towards finding those undervalued assets at some point in the not too distant future, maybe.
Exactly.
Would that be fair?
I think that's exactly right, Fritz. And that's what we'll be focusing on behalf of our clients.
That's great. Well, Steve, thank you for your insight. Steve and I will be back next week. We'll do another one of these videos. These videos, like all of our videos, are available on our YouTube channel and also on our website at 3edgeam.com. As always, please feel free to reach out to us anytime with questions, comments, or concerns. And on behalf of everyone at 3Edge, we implore everyone, stay strong and be safe. And thanks for listening. Thanks again, Steve.
Thank you all.